Good day all. Ira Epstein with your SPDR ETF video for this Monday, and we are on February 10th, 2020, just after 5 p.m. Central Time. So you know what we walk into on a day like this. You come back from the weekend. The coronavirus took out more people, unfortunately, over 900 dead, 40,000 plus cases. We'll get a new update about now. It'll be out there on the websites that you can see what it is. People are going back to work in China. It is not a mad rush, but people are going back. It is slow. I heard today that GM, Foxconn, they've set up some of the lines in their factories to make face masks. Yeah, away from their normal business, because the Chinese law is you got to have 2 face masks, I understand it, for each person right now. They have inspectors coming in and they look to see what is going on. Obviously, the big question is the disease spreading? But the one thing that we seem to see is that it's not as rough a disease as it could have been. As viruses go, and don't get me wrong, 900 people dead is a terrible. 1 person dead is terrible. But as viruses go, if you look at what happens in our flu season in America, this is a mild disease. The mortality rate is nowhere near what it could have been. That's the good news. The bad news, a lot of people are sick and my hearts go out for them. And it's all over the world. I mean, it hasn't hit Africa apparently, so I'm wrong on that. I really haven't heard that South America's been hit. It's Europe, it's Asia, it's the U.S. I haven't heard Mexico yet. Canada's got some. So we'll see what it does. But in areas that can afford it, it seems to be contained. And the stock market looked at this today, and it decided the market is friendly. It fluttered for quite a bit, but by the end of the day, you added 200 to the Dow. So let's take a look at what the market is doing. As you can see, you're at a new high in the technology sector. People think the factories are going to come back, blah, blah, blah. I'm praying that they're right. But if we look at the action, today's an outside day up. That means you took out the previous day's what? High and low. You opened lower, actually closed higher, and a new high for the move. So we'll call that a key reversal, an outside day. I don't know. I wouldn't call it a key reversal. I call it an outside day up. Now I put my swing line low right there. That is the number, today's low, I don't want to take out. If you take out today's low on Tuesday or Wednesday, I as a chartist came up with the idea that that's then a bull trap. And as a bull trap, the market then has caught a group of people long, and if it falls, I look to see where the closest moving average in the market is. And when I put on the moving averages, this is my 18-day, my 100, my 200. That number would be 97.66. Would that hurt the pattern? Here's what could happen. If you didn't first take out today's high, it would just keep dropping the market down and not hurt the overall pattern of higher lows, higher highs. If you first went up and then down, yes, it would look toppy, and you'd have to be careful as to what happened on the way back down. Next, I look to see where the Bollinger Band is. Now, if you look at Bollinger Bands, markets stay within them 95% of the time. I came up with a rule of thumb. I count each consecutive close over them or under them, taking away one of those percentage points. So if 95% of the time the market will stay within them and today the market's over it, then tomorrow what do I have? Well, you take one of those percentage points away and you come up with higher probabilities that it's going to come back down under it. The point is it's a resistance point, and the market often runs into resistance at that number. I then look at momentum. Is the market overbought? What's the definition of overbought? If the slow stochastic reading is over 70, it's overbought. When both numbers are over 80, they have to stay over 80 for at least 3 days, 3 time frames. And it changes to what we call locked in or embedded. That implies that on pullbacks, the market would be continued to get bought by them. By the pros until the red line closes back under 80. In other words, you're counting that momentum is leading price. It's not in play here. You're in an overbought market, not embedded, that's at a resistance point and it keeps running into a stall zone each time it's been hitting it. Doesn't have to, but it's also a strong Monday, and maybe you get that Tuesday reversal. By the way, I want to come back there. Is there any reason to be bearish? None. It's a question of, are you going to get a correction? Nothing bearish there. When I come over to the XLI service indicator, I've got a lower low, higher high pattern. That's not a trend. I don't have, in fact, let's just check this. Yesterday's high and this Friday was 84.15. You don't have an outside day. So I have a market that's overbought. I have a market that is trying to stay over the 18-day average, not trending. It's recently hit the lower band. I would expect that if it does get up to the upper band, it runs into pretty stiff resistance. 18-day average is the pivot area. It just seems to be moving back and forth there. Now on the energy sector, this is an important time. Here's a clear-cut embedded reading. My idea is that as the market rallies, the pros sell it until you lose that embedded reading, and you lost it right there. So this was Thursday. The market tried to stay down on Friday and did it, and today the market down a fraction more, but not back under these lows. So you've lost the embedded reading. Often, not the word always. I don't know how to use the word always. Often, this implies that the pros are not at work selling this market. If anything, they're looking for reasons to see if the market can get back to wherever that 18-day average is. Not a trend trade, but certainly when you lose that reading, a lot of reasons not to be adding shorts, as I see it. In the QQQ, this is running the upper Bollinger Band in an overbought condition. Been here, done this, but it's bullish. The market fought its battle at the 18-day average. It went up to the upper Bollinger Band. You've had days down, up, down, back and forth, each one of these. As you can see on Friday, the market closed under the band. Today you're back where? At 231.97, so you're just over the band. You're pushing the band out in an uptrend, but you are very overbought. Again, could be a Tuesday reversal. In the emerging market, EFA, if we look at this market, you can see that your battlegrounds right here. Now, you made a lower low, then you made a higher high than that, and you're just battling right now against this number. Market is waiting to see what's next. I don't see anything on this chart. I see it just sort of hanging right there now. In gold, you're caught in this narrow range of the Bollinger Bands. Again, 95% of the time, the market will trade within it. You can see how the first challenges failed back, and where did you go? You've been fighting at that 18-day average. Are we in a trend? No. You have a higher high and a lower low on the daily charts. Momentum is up and bias is up. On the chart, there's no reason to be short, but I'm also not seeing a reason to be long. I see support and resistance points, both hand in hand. In the gold miners, possibility here of something. You've been in a downtrend. Now, we had an outside day down in this market. Let me start with, I guess, this one. You had the outside day down here. If you take out the high of an outside day down within the day after or the day 2 days after it occurred. In other words, if that occurred on Friday, Monday, didn't take it out. If it takes it out tomorrow, it's what I call a bear trap. And when bear traps happen, they take this area and those people are caught because you've gotten over anyone that stayed short in there. And the question is, can you lift? My rule of thumb is that if it takes out this 2867, then I'm looking for the upper Bollinger Band as a target. Could be interesting. Same thing could be said of the miners, but you can see how you're fighting at these, 18-day average? You look at the 18-day average here. Tell me that's not the number that this market's winding against. Seems to be it. In TLT, when we lost the embedded reading, and this is the classic case of it, if you lose it, I'm looking for prices to come down, and here you go, to the 18-day average. It all happened at one time. Now, does it have to hit the number? It has to get in the zone. I don't call the zone, for example, 30 cents away, but this is pretty darn close, and you can see you fought your battle there, and the market's trying to come up. Are we trending? No. You have an overbought market. You have the bias up since you're over the 18-day average, but you're not trending. You have a higher high, lower low. When we come over to USO, the energy ETF, unlike the other parts of the energy, this has just stayed embedded. Until you lose that embedded reading, you're still very much, as far as I'm concerned, in the bear camp in this market. When you lose it, that's when I look for the markets to do something else. What else? When we had back here, and that's why I like to use moving averages, this bearish crossover, the market just went on a plunge from that point. Now, it made it right away the low, and this is really the first test of that 1040 area. It made a lower low than when it first did. It's accomplished what it has to on the downside as a technician. That does not mean the trend has to end. That's not what I'm saying in any manner. But I am saying I wouldn't want to see as a bear 1089 taken out, and I certainly don't want to lose that embedded reading. That'll imply the chart is taking on a different life. In FXE, which is the dollar, the euro versus the dollar ETF, lower highs, lower lows, running the lower Bollinger Band. Gets to the left-hand side, then the right-hand. Is it embedding? Well, both numbers today were under 20, both under 20 yesterday and the day before, so it's a full yes. So on rallies until that red line closes back over 20, I'm expecting to see the market find willing sellers in this market. You also back here had another bearish crossover. You see where the 18 and the 100 are, and then the market, what did it do? It went down for the new low. So I do watch crossovers. People ask if I do that, and I certainly do. But I watch everything, and because it's a puzzle. You're trying to put things together. What I don't try to do is put my own thought into a trade. That is the hardest thing for traders to understand, but it's the way that it works. I use a lot of technical tools. I write about the markets, and one of the tools that I look at when I get into chop affairs, not the way the ETFs are right now, but the regular futures markets, not in the stock ones either, it's the others. I'm looking real hard at these pivot points. And that's because markets tend to go sideways, whipping up and down. Gold's an example of that right now. So you're looking for this formula, and it's a pretty simple, basic formula. It's out there in Wikipedia. Your charting service has it most likely. And you're looking for that neutral line with resistance points above it, support points below it. And off of that, I'm looking for the timing. I want to see what the pros are doing in terms of, are they covering at any of these points as you get up too high? Are they putting on new shorts, for example? Are they putting on new longs? And I'm using the slow stochastic in a very similar manner that you see here, but it's not exactly the same. And I explain that in the videos. How do you get these videos? It's 3 and they're totally free. Just go to our website, our free offers. You can get that and our other offerings. You can click up here. It'll take you there as well. I'm Ira. You have a good day, and I will see you all.